What if one meeting in Washington could change the cost of your mortgage, your credit card, your car loan, your savings account, and even your investments? It sounds unbelievable, but that's exactly what happens every time the Federal Reserve announces its interest rate decision. Millions of Americans hear the headlines. The Fed holds rates. The Fed cuts rates. The Fed hikes rates. But very few people understand what those words actually mean or why they matter. The truth is, one decision from the Fed can save you thousands of dollars or quietly cost you even more. So before the next Federal Reserve meeting, there's one question everyone is asking. Will the Fed finally cut interest rates or keep borrowing costs higher for longer? In this video, we'll break down what the Federal Reserve is likely to do, why inflation is still driving the conversation, how Wall Street is reacting, and what this decision could mean for your mortgage, credit cards, savings, retirement account, and overall financial future. Let's get started. Before we talk about the next decision, we need to understand who's making it. The Federal Reserve, often called the Fed, is America's central bank. Its job isn't to make the stock market go up. It isn't to make houses cheaper. And it doesn't work for politicians. Its primary mission is surprisingly simple: keep inflation under control while supporting a healthy job market. To do that, the Fed has one powerful tool: interest rates. When inflation rises too quickly, the Fed usually raises rates to slow borrowing and spending. When the economy weakens, it may lower rates to encourage businesses and consumers to spend more. Think of the Fed as the thermostat for the U.S. economy. If the economy gets too hot, it turns the temperature down. If it gets too cold, it turns the temperature up. But getting that balance right isn't easy. And that's why every Fed meeting attracts attention from investors, businesses, and families across America. Here's why this next decision matters so much. Over the past few years, Americans have dealt with some of the highest borrowing costs in decades. Mortgage payments climbed. Car loans became more expensive. Credit card interest rates reached record highs. Many families began asking the same question: when will interest rates finally come down? The answer depends on one thing: inflation. Inflation measures how quickly prices rise across the economy. When inflation is too high, people lose purchasing power because their money buys less than it used to. That's why the Federal Reserve has spent years trying to slow inflation back toward its long-term target of around 2%. But there's a challenge. If the Fed cuts rates too soon, inflation could rise again. If it keeps rates high for too long, economic growth could slow, businesses may hire fewer workers, and unemployment could increase. That's why every word in the Fed's statement and every sentence from the Fed chair's press conference is closely analyzed by investors around the world. Sometimes, it's not the interest rate decision that moves the markets. It's the message about what could happen next. You might think the Fed only matters to Wall Street, but the reality is very different. Its decisions can affect almost every American household. Let's start with mortgages. If interest rates stay higher, buying a home becomes more expensive because monthly payments increase. For current homeowners with adjustable rate loans, monthly costs can also rise. Next are credit cards. Many credit cards have variable interest rates. When the Fed keeps rates high, carrying a balance becomes much more expensive. That means paying only the minimum balance could cost thousands of dollars in extra interest over time. Now let's talk about car loans. Higher rates often mean higher monthly payments, making new vehicles less affordable. But there is some good news. If you have money in a high-yield savings account or certain certificates of deposit, higher interest rates can help your savings earn more. That's why the Fed's decisions create both winners and losers. Borrowers generally prefer lower rates. Savers often benefit from higher rates. Understanding this relationship can help you make smarter financial decisions before the next rate move. Processing fees, legal charges, insurance requirements, prepayment rules, customer service, flexibility for future rate changes. Sometimes a slightly higher rate comes with lower fees and better loan features. Mistake number 2, borrowing more than you need. A larger loan means higher EMI, higher total interest, more financial stress. Borrow responsibly. Mistake number 3, ignoring your credit score. Your credit score affects not only approval, but also the interest rate you may receive. Review your credit report before applying and resolve any errors if possible. Mistake number 4, not reading the fine print. Always understand interest rate type, reset frequency, charges, penalties, conversion rules. Prepayment conditions. If something isn't clear, ask questions before signing. Mistake number 5, skipping loan comparisons. Don't rely on just one lender. Compare offers from multiple banks and housing finance companies before making your decision. A few hours of research could save you money for years. Final thoughts. Let's quickly summarize today's video. Heavy checkmark home loan rates remain competitive for qualified borrowers. Heavy checkmark your credit score plays a major role in determining your interest rate. Heavy checkmark compare the complete loan package, not just the headline rate. Heavy checkmark understand the difference between fixed and floating loans before choosing one. Heavy checkmark keep your EMI affordable and borrow responsibly. Remember, the goal isn't simply to buy a house. The goal is to buy a home without creating unnecessary financial stress. A home should bring peace of mind, not sleepless nights. Making a careful, informed decision today can benefit you for many years to come. Call to action. If you found this video helpful, please give it a thumbs up and subscribe for more straightforward updates on home loans, personal finance, investing, and money management. Every month, we break down the latest financial news into simple language so you can make smarter decisions with your money. I'd also love to hear from you. Leave a comment below with your city, your approximate loan amount, whether you're buying your first home or refinancing. I'll do my best to point you toward the types of lenders that may be worth comparing based on your situation. Thank you so much for watching. Take care, stay financially smart, and I'll see you in the next video.